Here is a number that should stop you in your tracks. By the end of 2025, the European crypto market was valued somewhere between 1.5 and 1.8 trillion euros, and according to Chainalysis, Europe has quietly become the single largest cryptocurrency market on the planet. Not Asia, not the United States. Europe. The region now hosts more than 100 million crypto users and roughly 140 million wallet holders, with wallet adoption climbing around 12% year-on-year. So the obvious question is, why is crypto trading suddenly exploding across the European Union, and which countries are actually driving this surge in ownership and holdings? In this video we dig deep into the latest reports and pull out the hard numbers, so you understand exactly what is happening and why it matters. To understand the boom, you have to start with one piece of law. In December 2024, the European Union switched on MiCA, the Markets in Crypto Assets Regulation. This is the most comprehensive crypto rulebook in the world, and it did something the industry had been craving for a decade. It gave the market clear, predictable rules. Under MiCA, crypto firms must register as crypto asset service providers, with licensing applications beginning in January 2025 and a grandfathering window letting existing players operate until the 1st of July, 2026. By the first quarter of 2025, more than 65% of EU-based crypto businesses had already achieved MiCA compliance, and the number of registered virtual asset service providers across the bloc jumped by 47%. Clarity, it turns out, is rocket fuel. Regulation alone does not move markets, but trust does, and that is precisely what MiCA delivered. When investors know the rules, they commit capital. The data backs this up clearly. After MiCA's investor protection measures took effect, more than 30% of institutional investors in the EU increased their crypto holdings. Even more telling, over 50% of European banks are now planning MiCA-related partnerships by 2026. Think about that for a second. These are conservative, heavily regulated institutions, the kind that historically kept crypto at arm's length, now actively building bridges into the sector. The framework effectively gave traditional finance permission to step in. That single shift in confidence is one of the biggest reasons trading volumes across Europe have accelerated so sharply through 2025 and into 2026. The second major driver is institutional money, and the scale here is genuinely staggering. The arrival of regulated crypto exchange-traded funds and exchange-traded products changed everything. These are familiar, regulated wrappers that let banks, pension funds, and hedge funds buy crypto exposure without touching a wallet. In 2025, Bitcoin ETFs across the US and Europe were pulling in over $80 million in daily inflows, while Ethereum ETFs added $743 million in just 2 weeks. The giants of asset management, BlackRock, Fidelity, Franklin Templeton, Invesco, and VanEck, now oversee tens of billions of dollars in spot crypto products. BlackRock's Bitcoin product is reported to be the fastest-growing exchange-traded product by assets under management ever recorded. European infrastructure players like Deutsche Börse expanded custody and trading services to keep pace. So where exactly is all this trading happening? When you rank European nations by raw on-chain trading volume, the leaderboard is fascinating. Russia leapt to the top of European trading with $376.3 billion in volume. The United Kingdom came second with $273.2 billion, and Germany took third place with $219.4 billion. These three economies alone account for an enormous slice of European crypto activity. What is striking is the mix: a sanctioned economy seeking alternative rails, a global financial hub in London, and Europe's industrial powerhouse. All appearing at the top for very different reasons. It is a reminder that crypto adoption is never driven by a single story, but by local economics, regulation, and culture all at once. Let us zoom into the United Kingdom, because the numbers here are remarkable. The proportion of British adults owning crypto jumped from 18% in 2024 to 24% in 2025. That is roughly a third more owners in a single year, an extraordinary pace for a mature, wealthy economy. The UK is interesting because it sits outside MiCA, operating its own regulatory framework as it builds a bespoke set of rules for digital assets. Despite that, or perhaps because of the competitive pressure to keep London relevant, ownership surged, with a particularly sharp jump among younger adults during 2025. For a country that prides itself on being a global financial center, this rapid climb signals that crypto is moving from the fringe firmly into the mainstream of British personal finance. Germany is perhaps the clearest example of MiCA's impact in action. Europe's largest economy recorded a 54% year-on-year increase in crypto activity, a direct dividend of the new regulatory clarity and the entry of established financial institutions. With an adoption rate around 8.9% and that $219 billion trading volume we mentioned, Germany shows what happens when a rule-loving, institutionally minded culture is finally given a rulebook it can trust. German banks and asset managers, traditionally cautious, now have a legal pathway to offer crypto services. The combination of a huge savings pool, strong financial infrastructure and regulatory certainty has turned Germany into one of the engines of European crypto growth, rather than a skeptical bystander as it once was. Now for a very different story. Turkey reports one of the highest crypto ownership rates anywhere in the world, with roughly 25.6% of its internet population holding cryptocurrency. The driver here is not slick ETFs or institutional custody, it is survival economics. Years of high inflation and a steadily weakening lira have pushed ordinary Turkish citizens towards crypto, and especially towards dollar-pegged stablecoins, as a way to protect their savings. This pattern mirrors what we see across Latin America, where the average national adoption rate hit 15.2%, again largely because people are hedging against inflation and unstable local currencies. It is a crucial insight: in stable economies crypto is an investment, but in inflationary ones it becomes a lifeline. Both are powerful forces driving adoption higher. Here is something the headline figures hide. While Western Europe dominates in absolute trading volume, the real grassroots energy lives further east. When you adjust the data purely for population size, Eastern European countries take the top spots. Ukraine, Moldova, and Georgia all punch dramatically above their weight, driven by intense bottom-up, everyday crypto activity rather than institutional flows. In these nations, crypto is woven into daily life, used for remittances, savings, and cross-border payments by ordinary people. This grassroots adoption is arguably more durable than speculative trading, because it reflects genuine utility. It also explains why Europe's overall adoption rate of 8.9% understates the picture. The regional intensity in the East is far higher than any single block-wide average can capture, and it continues to deepen. No European crypto story is complete without Switzerland. According to Statista's Global Consumer Survey, Switzerland has historically held the highest cryptocurrency adoption rate of any European country. That is no accident. The Swiss canton of Zug, nicknamed Crypto Valley, has spent years cultivating a friendly, sophisticated environment for blockchain businesses, attracting foundations, exchanges, and developers from around the globe. Switzerland combines deep private wealth, world-class banking, and clear, pragmatic regulation, a near-perfect cocktail for high adoption. While it is not part of the European Union and therefore not bound by MiCA, its influence on the wider continental market is significant. It acts as a high-end corridor where institutional and private wealth experiment with digital assets, often setting trends that ripple outward into the broader European ecosystem. One of the most underrated consequences of MiCA is what it did to stablecoins, and the numbers are eye-watering. Because MiCA imposes strict rules on which stablecoins can legally circulate in the bloc, the market rapidly recalibrated towards EU-compliant options. Circle's euro-backed stablecoin EURC achieved an astonishing 2,727% growth between July 2024 and June 2025. Compare that to the 86% growth of the dollar-pegged USDC over the very same period. That is not a typo, it is a regulatory earthquake. It shows how powerfully law can redirect capital, channeling demand towards compliant, euro-denominated assets. For Europe, this is strategically huge, because it builds a homegrown digital euro ecosystem rather than leaving the continent dependent purely on dollar stablecoins issued elsewhere. It is not all expansion, and this part matters. MiCA is also triggering a brutal shakeout among service providers. Europe had around 3,167 registered virtual asset service providers, but projections suggest that 70 to 75% of them are set to lose their registration status under MiCA's grandfathering rules by mid-2025. In other words, the majority of crypto firms may not survive the transition to full regulation. This is consolidation in action. The market is getting bigger in value while getting smaller in the number of players. The survivors will be larger, better capitalized, and more compliant. For everyday users, this generally means safer platforms, but it also means less choice and more concentration of power among a handful of well-resourced, fully licensed European crypto businesses. So let us pull it all together. European crypto trading is booming for three connected reasons. MiCA gave the market the regulatory clarity it craved, institutional giants like BlackRock poured in tens of billions through ETFs, and ordinary citizens, from Britain to Turkey to Ukraine, turned to crypto for investment, protection, and everyday utility. Ownership is rising fastest where either confidence is high, like the UK at 24%, or where currencies are fragile, like Turkey at over 25%. The big picture is unmistakable. Crypto in Europe has transformed from a retail-driven gamble into a mainstream, institutionally backed asset class worth well over €1 trillion. The next 18 months, as the July 2026 deadline bites, will decide who leads this new financial era. If you found this analysis useful, stay tuned for more deep dives.